Everyone talks about order blocks, but very few understand what's actually going on behind them. So in this video, I'm going to break down what an order block really is, not just by definition, but through the bigger picture smart money concepts of the 5 phases of market manipulation. I mentored hundreds of people on smart money concepts, white cop strategies, and this is really the biggest mindset shifts that levels up their execution. So in order to understand this concept, we have to understand something first, that the markets are not fair. There's a huge imbalance of wealth between retail traders like ourselves and major banks, institutions, and hedge funds. You got to understand that banks make up the top 10 currency traders in the world. And in terms of overall percentage of the market, just the top 10 alone pump in about 60%. So imagine all the other banks as well. So now we understand that banks control the flow of money and the flow of price in the market. They don't chase trades, they create trades. But here's the thing that we can take advantage of. They cannot hide their footprints in the market, meaning they can manipulate the market all they want, but they cannot hide the signs of their manipulation on a chart. This means that at some point they have to show their hand if you know what to look for. So that's where order blocks really come in, not as magic boxes on your screen, but as part of a 5 phase plan for how the market is manipulated before the move even happens. All right, let's get into it. So phase one is the enticing phase. So what does it mean to entice? So enticing means to lure, to bait, someone into a certain action. In this case, the first part of manipulation is where they are luring the masses into doing a certain action. This can look a little something like this, where we see the market constantly rejecting off of the same level, making people think that will probably continue to the upside. This is going to create a large amount of people that are going to be buying here and putting their stop orders underneath here. You can imagine hundreds of thousands of maybe even millions of people all looking to have their stop orders in the same place. This creates money below certain areas. This creates areas of what we call liquidity. That's what the enticing phase is all about. That's what the enticing phase is all about. It's all about creating liquidity. Now, what we have to understand about stop orders is they actually are where buyers become sellers. They're forced to become sellers of their asset at a lower price. For example, someone buying an asset at $2 and having their stop loss at $1, if the market were to hit their stop loss, they're going to have to sell their asset for $1. Now, if we're selling here, guess who is buying? The major banks and institutions. This is why market manipulation has to happen to give the institutions an opportunity to get into the market. This brings us into the manipulation phase, where the banks are looking to hunt these orders that are sitting below these lows. The banks will use their resources to sell large amounts of an asset and force the price down to reach those orders. And that's where phase two comes into play. Now, all these stop losses and pending orders have been hit, which allows the major banks and institutions to buy even more. All right, now this money has been cleared out, so we're going to replace it with an X. Now we enter into the impulsive phase. This is where we now see the effects of the manipulation phase, allowing these orders to be created that will allow the market to move extremely impulsively in one direction. Understand that in order for big movements to be created, this process has to happen to create those orders that the major institutions need to move the market. Now we go into phase four, which is the mitigation phase. Mitigation phase is where we as traders are looking to take our entries. So basically understand that the first 3 phases that we see on the screen, this is our evidence for going ahead and looking for positions in the market. Meaning, as traders, we have to be patient enough to allow phase 1, 2, and 3 to happen. So what does it mean to mitigate? Mitigation is the action of reducing the severity, seriousness, or painfulness of something. But what's painful about this situation for the banks? Understand that in order for the banks to bring the market down, they had to put money in. They had to actually use their resource to force that to happen. Now, since they're shorting the market here, they're going to be losing so much money when price moves all the way over here during the impulsive phase. So if you can control the market, are you just going to leave that money on the table? Probably not. No, you're going to bring the market back down to a point where it's at least at break even, if not in a little bit of profit to those previous sell orders. And this is where we find our opportunity to get into the market. So while they're closing out their sells, they're also entering into more buys. This is what causes the continuation phase. The continuation phase is where we be hitting our TPs. It's our favorite phase. This is where you catch the move with confidence because you're not guessing, you're tracking the information and the flow of money in the market. So where do order blocks play into this? Order blocks are typically created inside of the manipulation phase and inside of the mitigation phase. Order blocks become clear when we move away from moving on a line type of chart to looking at candlesticks. Order blocks are essentially candles that go ahead and take out areas of liquidity. So we want to see this manipulation phase happen all with one candle coming down. This candle typically is going to be very impulsive. It's going to be very fast because it's meant to create fear. So some things that we want to understand about order blocks is that they are mostly body and not wick. We want to see that an order block takes an area of liquidity that we have identified. We want to see that an order block is shown on multiple time frames. We look at it as the last down candle before an up move. And we want the candle ideally to open above or below liquidity and close below or above liquidity, depending on if we're talking about a buy setup or a sell setup. So it can look something like this, where we have this last down candle before an up move. Typically looks like an engulfing candle, but not all engulfing candles are order blocks. We have to see the rest of this really play out. So let's go ahead and look at some examples. I would say right here looks like it could be a good example of an order block. See how many buyers were enticed in this range here throughout this whole process. Then we see one candle come down, take out all of those buyers at the same time before seeing price impulse away. We don't necessarily need to see that impulsive phase be one candle, but we do want to find that the manipulation phase is one candle. We can even see it here on multiple time frames. Build up of lows here before we go ahead and sweep everything out and impulsively trade away. So we're going to make our phase 2 yellow. We're going to make our phase 3 blue. We're going to make our phase 4 purple. And we're going to make our phase 5 green. So understand that valid order blocks aren't just about engulfing candles. They're also about the context of the situation and if we can actually see the setup appear on multiple time frames. For example, over here we have an engulfing candle. But does that mean that we should take a trade in this area? Probably not, because the context is most important. If we are just coming off of a previous 5 phases, we aren't going to look for price to suddenly reverse at the next order block. There's a chance that we can see this go much, much farther, which of course we do. But understand that when it comes to finding these 5 phases, context is the most important thing. We want to make sure our order block follows our rules before we're going to go ahead and take a position based off of it. We also want to see where the most recent money flow was to have an understanding of whether or not we should trust an order block to actually play out. The key point here is stop trading a box and start trading the story of what's been happening in the market. You cannot ignore what happened before an order block. We can't try to chase every type of mitigation because we won't be consistent. So now we can understand that order blocks aren't setups, they're clues. The real edge is knowing and understanding what happened before them. If this gave you any type of clarity, imagine what's going to happen when we walk through this step by step, live, chart by chart, 3 times a week. All right, make sure you guys check out our community on Discord if you guys want to stop gambling and start thinking like the institutions. All right, if you guys enjoyed this video, do me a favor, subscribe, like, comment, and I will catch you guys on the next one. Peace out.